Hey everyone, and welcome. Today we are diving into one of the most powerful yet often misunderstood tools in a trader's entire toolkit, the trailing stop. If you have ever, and I mean ever, sat there staring at a winning trade, just agonizing over when to sell, then you are in the right place. I mean, this is the million-dollar question, right? We've all been there. You're up on a trade, it feels great, but then every little dip makes your heart skip a beat. And every time it rallies, you're thinking, how much higher can this thing possibly go? Trying to pick that perfect top feels, well, it feels impossible.
So, here's what we're going to cover. First, we'll unpack that emotional problem every trader faces. Then, we'll introduce the solution, the trailing stop itself. We'll get into the different strategies for using them, cover the common mistakes you absolutely want to avoid, and finally, we'll wrap it all up by showing why this is such a game changer for becoming a more disciplined trader.
All right, first things first, let's talk about the real issue here. Because honestly, managing a winning trade has less to do with the chart in front of you and everything to do with managing the emotions inside your head.
This is that voice in your head, isn't it? It's the classic battle. You've got fear on one shoulder, screaming, sell now, take the money and run before it disappears. And then you've got greed on the other shoulder, whispering, hold on, just a little longer, this could be the big one. Both of those emotions, fear and greed, can lead to terrible decisions. You either leave a fortune on the table, or, even worse, you watch a beautiful winner turn into a painful loser.
So what's the secret? Well, it's having a system. The goal isn't to become some emotionless robot, but to use a tool that follows a plan you made when you were calm and rational, taking those impulsive, heat-of-the-moment decisions completely off the table.
And this chart just nails that emotional roller coaster, doesn't it? You get in a trade feeling optimistic. Then, as it moves your way, you feel the excitement build. But then comes the first normal dip, and suddenly anxiety creeps in. If that dip gets a little deeper, it turns into straight-up fear. And that fear often leads to pure panic, and you end up selling at the worst possible time. A trailing stop is designed to short-circuit this entire destructive cycle.
Okay, so what exactly is this magic tool that can save us from ourselves? Let's get formally introduced to the trailing stop. Think of it as your own personal, dynamic safety net.
So in the simplest terms, it's a stop loss that moves. As your trade gets more and more profitable, your stop loss automatically moves up right behind it, basically creating a rising floor that protects your gains. But the moment the price turns against you, that floor stays put, ready to catch you and lock in what you've made.
And this right here is the key difference. A regular stop loss is static. It's like an anchor. You set it once to define your maximum risk, and that's it. A trailing stop, on the other hand, is dynamic. It's alive. It's actively working for you, not just to limit your initial risk, but to aggressively protect your hard-won profits as they grow.
Okay, let's walk through this example because this makes it super clear. You buy a stock at $100 and set a 10% trailing stop. Your initial stop is at $90. Now, the stock goes on a fantastic run-up to $120. Your stop doesn't just sit back at 90, no way. It follows the price up, always staying 10% behind. So it's now at 108. Then the stock has a little pullback to 115. Your stop doesn't move down, it stays firm at 108. If that pullback continues and hits 108, boom, the trade is closed automatically and you just locked in an 8% profit. No guesswork, no emotion.
All right, so the concept is pretty cool, right? But the next question is, how do you actually set one? It's not one size fits all. There are a few different ways to do it, so let's check out the most common strategies. You've basically got two main flavors here: fixed distance and percentage-based. A fixed distance, like say 50 cents or $1, is great for really stable, less volatile assets. But for most things, especially things that can make big moves, a percentage-based stop is usually the way to go. Why? Because it adapts. A 5% stop on a $10 stock is 50 cents, but on a $100 stock, it's $5. It scales with the price, which is exactly what you want.
And this is absolutely crucial to understand. You cannot just pick a number out of thin air and apply it to everything. A 5% trailing stop might be perfect for a big, steady stock like Apple, but if you try to use that on Bitcoin, you'd get stopped out in about 5 minutes. You have to match the stop to the asset's typical volatility. These here are just some common starting points to give you an idea.
Now, if you want to get a little more sophisticated, you can tie your trailing stop to technical indicators. You could trail it just below a key moving average, which is fantastic for trend following, or you could use the average true range, the ATR, which is awesome because it automatically widens your stop when the market gets choppy and tightens it up when things are calm.
And of course, there's the more hands-on approach of manually trailing your stop just below significant support levels as the trade moves up.
Okay, time for a dose of reality. A trailing stop is an incredible tool, for sure. But, and this is a big but, if you use it the wrong way, it can actually hurt your trading more than it helps. So let's cover the big mistakes you need to avoid.
And this is without a doubt the #1 mistake. It's the Goldilocks problem. If you set your stop too tight, you're going to get shaken out of a perfectly good trade by normal everyday market noise. That's called getting whipsawed, and it's incredibly frustrating. But if you set it too wide, you risk giving back a massive chunk of your open profits before it triggers, which kind of defeats the whole point. Finding that just right distance is key.
Beyond just placement, there are a few other things to be aware of. Price gaps are a big one. Imagine you go to bed. Your stop is sitting at $50, but some bad news comes out overnight and the stock opens at 48. Well, your order is going to execute at 48, not 50. And you always have to remember, this is a tool to help you execute your plan. It is not a replacement for having a plan in the first place.
And listen up, because if you only remember one rule, make it this one. This is the cardinal sin. The entire point of a stop is to enforce discipline. The second you move your stop further away from the price, giving the trade more room just because it's going against you, you have completely destroyed its purpose. A trailing stop moves in one direction and one direction only, towards locking in more profit, period.
All right, let's bring this all home. In our last section, let's see how this all comes together. Because when you use it right, this isn't just another order type. It's a whole framework for building discipline.
So let's look at this powerful example. Let's say a stock goes from $100 to $120. You're using a 5% trailing stop. At the peak price of $120, your stop is trailed all the way up to $114. When the stock pulls back and hits that level, you're out. You just locked in a 14% gain. Without that stop, who knows? Maybe you would have panicked and sold at 105 or gotten greedy and watched it fall all the way back to break even. The system protected you.
So, what's the big takeaway here? Why is this such a game changer? Because it puts your profit protection on autopilot. It rips fear and greed out of the decision-making process. It gives you the confidence to let your winners actually run without getting scared. It works across stocks, forex, crypto, you name it. And most importantly, it forces you, day in and day out, to be a disciplined trader. So I'm going to leave you with this question to think about. So many traders are obsessed with finding the perfect entry point. But what if the entry isn't the problem? It's often the exit strategy, or lack thereof, that separates the consistently profitable traders from everyone else. So take an honest look at your own trading. Could a more systematic, less emotional way of getting out of your trades be the thing that finally unlocks the next level for you?